How long has it been since you've worried about the risks in your money market funds? For me, it goes all the way back to 2008. I've recently had some conversations, though, with people who are much smarter than I am, and they're concerned about the potential risks in particular, prime money market funds. It's not inappropriate to say that most advisors and investors consider their money market funds to be safer than risk assets. But are they? Let's start with what is a prime money market fund. According to the Charles Schwab website, prime money market funds primarily invest in taxable short-term obligations issued by corporations and banks, as well as repurchase agreements and asset-backed commercial paper. Note, the SEC has changed the rules governing money market funds 3 times since 2008, in 2010, 2014, and last year in 2023. In an informative article from the law firm Rogers and Gray, I learned about 2 terms from the most recent release last year that really require more research. These terms are liquidity fees and reverse distribution mechanisms. Those are not the terms an investor wants to read about when it comes to their safe money. It's fair to say that liquidity fees and reverse distribution mechanisms would not be used unless the markets were under extreme duress, which is exactly when you have the highest likelihood of needing those funds. So, are Treasury money market funds the solution? As the name suggests, these funds will invest in the U.S. Treasury market. Generally, you get the same liquidity as the prime money market funds while giving up a little bit of yield. In a Treasury money market prospectus I read recently, it says, quote, "The full faith and credit backing is the strongest backing offered by the U.S. government and traditionally is considered by investors to be the highest degree of safety as far as payment of principal and interest." Sounds great, right? Well, in that very same prospectus, in the next paragraph, it says, quote, "Based on the fund manager's view of market conditions, the fund may invest up to 20% of its assets in obligations that are not guaranteed by the U.S. Treasury, including Fannie, Freddie Mac, and Federal Home Loan Banks." Remember 2008? Is it worth that risk for your safe money? Probably, but is probably good enough? I personally prefer Treasury ladders today. Here's the takeaway for advisors. Research any prime money market fund that you're using and document your assessment of those risks in your investment committee meeting. Put it on the record. Determine if a different money market fund would be a better solution, but be sure to read the prospectus. And then call your clients and prospects who have money held away from you and just offer to read the prospectus for them. You know they're not reading it, and it could open up some conversations. And for investors, as always, whenever you're going to invest, know what you're investing in, read the prospectus, even on your money market funds. The name of the fund might not be telling you the whole story. Please reach out if you have any questions.